Let's talk global, and Rober Parket, Vice Chairman of Asset Management at Credit Suisse, joins us now from London. Robert, hi, thanks so much for joining in. How are you viewing, I'll jump straight to what impacts me and my viewers, the Indian markets. What's your view on the Indian markets at this point of time? We've corrected a little bit, but in light of the data points that have come out, government action that has come out, the GDP, how are you viewing the Indian markets?
Well, I think, first of all, on the economics, the growth numbers for India, I think, for the rest of 2010 will remain strong. And we've consistently said that the second half of this year, Indian growth in terms of real GDP should average between 8 and 9%. I think given the global slowdown in the developed economies, the probability of growth accelerating above 9% is a very low probability, but conversely, I would be surprised if we see much of a moderation in the Indian economy. Clearly inflation remains a problem, although I think as we go into 2011, we actually may see some better numbers on the inflation front. But if one asks the question, has the RBI finished the monetary tightening cycle, I think the probability of that is very low indeed, and I think that the trend in monetary policy is for a further, albeit modest, tightening, and that obviously is a headwind for the Indian equity market. In the near term, India clearly is not going to be immune from the global trend in equity markets, and unfortunately, and I think this is clearly evident by market action this week, that we will see further downside in September in global equity markets. Having said that, as we go into late September and early October, our view is that global equity markets, led by emerging markets, actually will see a fourth quarter rally. But near term, I think one has to remain very cautious.
Robert, how about the fact that a lot of people say that inflation might taper down in India in the next couple of quarters, the fact that this was due to a low base effect, once the high base effect kicks in, even the growth would probably show a bit of moderation, and in light of that, the Reserve Bank will actually go a bit slow as opposed to hiking the rates in the September policy itself. You don't think that's a possibility?
I think, whether it is September or October, I think there is probably one further increase in interest rates likely in India. But I think the overall theme will be that monetary policy will be tightened once more, and I think that's probably it. And as we go into 2011, I think the Reserve Bank of India will probably be on hold, and as the inflation numbers start to improve, albeit slowly, in the first half of 2011, by the second quarter we actually could start to see monetary policy move towards more of an easier stance. That's obviously very positive for the Indian equity market as we go into 2011. Having said that, short term, we've got these headwinds.
Robert, you ruled out the possibility of a double dip in your earlier comments, but a lot of investors seem to be cautious, especially with the data coming out from the US as well, and say that there could be a possibility that there could be a double dip. September is anyways known to be a bit soft a month for equities. How do you play equities as an asset class in the emerging markets over the next 2 months?
Well, you're absolutely right to highlight that seasonally, September has historically been a difficult month for equities, and we shouldn't ignore that seasonal factor. In terms of a double-dip recession, our view is clear, which is that we are seeing a moderation in global economic growth. The third quarter of this year, we could see quarter-on-quarter annualized growth numbers out of China closer to 7% rather than the sustainable growth level of between 8 and 10%. In America, clearly the economic numbers on consumption and housing and actually exports in the last 3 months have been very poor. I think that's consistent not with a double-dip recession in America, but it is consistent with a period of mediocre growth. Our growth forecast for 2011 for the United States is 2.5%. Now that is not a good number, because that means that unemployment in America will remain elevated above 9%. In terms of how you play equity markets, I come back to my comment earlier that I think, given the volume of cash sitting on the sidelines, and given that investors arguably are discounting too much bad news in the global economy, I do think we could see a fourth quarter rally, and particularly the relationship between equities and global bond markets is now showing equities to be very cheap relative to expensive bond markets. In September, the next sort of 2 to 4 weeks, I think it's correct to stand on the sidelines and only come in as a buyer on market setbacks, and I'm afraid we probably will get further market setbacks in the near term. In terms of what one goes into on market setbacks, I think the strategy has got to be to focus on emerging market equities.
Robert, I know I'm keeping it very India specific today because the markets are doing what they are doing, and which is why I'm forced to do that. But emerging market back in general, and India in particular, you did mention that there will be a setback. How deep a setback from the current levels could we see, if you have a view particularly on India than that, or emerging markets in general?
Over the next 2 to 4 weeks, I think that emerging markets could see downside of the order of 5%. I don't think, given the very low bond yields we have, given the very high level of investor cash, that we are going to see greater downside. And, you know, there are a number of market strategists who are forecasting downside of 10 to 15%. Frankly, I think that is unlikely. And I think that India specifically will probably trade in line with global emerging markets in the near term. On a rally later in the year, I think given the valuation of India relative to, for example, China and Brazil, we could see some lagging of the Indian market relative to those other markets, which are very cheap.